In honor of launching our new Fund 6, we've got a very special lineup. We were just talking, actually. We think it may be the first time we've had all three founders on one webinar. So you're a very lucky audience today. Turbulent times, the world has been a crazy place for the last few months, as you all know. I think this is a great opportunity really to get the insights of the three GP Bullhound founders to think about, where you're going to be investing in the future, what you're doing with your current portfolio and the themes that are developing all around us. We're an organization steeped in the future. And you'll also hear a little bit about our 10-year vision for what we as an organization want to do to really kind of change the environment around investing and advising and keeping on supporting the entrepreneurs as we have been for many years. So if you do have questions, drop them in the box at the bottom of your screen. We'll try and get to them later or maybe as we go. But I think I'll just get straight into it really with the team here and welcome the three founders, Hugh, Manish and Per. It's great to have you all here. Let's get into it. I think everyone's worried about what's going on in the world right now. They're worried about their portfolios. They're worried about where they're going to invest going forward. You guys are working on the coalface, or your organization works within the coalface all the time of technology, working with founders. What are you hearing? What's the worries? What's the feeling? How's business going right now in this new normal? Manish, maybe we'll start with you. What are you seeing?
I mean, it's really interesting when we look across the group as a whole now. We obviously have the public equity markets and a team focused on that. Then we have the M&A markets, then we have the fundraising markets, and then obviously the investment activities. And what you're seeing is the market is really not connected at the moment. So when we look at the public software valuations, if we take a cohort of the top companies and just broad numbers, we're seeing as a revenue multiple, the valuations have really moved from kind of 17 to 20 times, so very aggressive, now towards more like 7 to 9 times on average. When we look at that on the private markets and some of the deals that are getting priced on the M&A side and the investment side, that hasn't corrected anywhere near as much. So some of those stocks have corrected by 50 to 70%. There was an interesting article on the private market from SharePost, which is one of the biggest exchanges that tracks all of the private unicorn, the biggest companies. And it's just started seeing a correction, so kind of 20% decrease in valuation, but nowhere near as the public market. So that's very disconnected. And then also what we're seeing through the M&A side is the valuations are still holding up as very robust. And there'll be a migration because it can't continue like that. But the whole chain is not really linked up at the moment. I guess one of the concerns is tech has had such a strong run, and that has allowed a lot of IPOs to happen. The IPO markets have had probably one of their strongest periods ever. And that then flows money back into the system, the investors get their money, and that flows through to the next generation of startups. We're seeing that IPO market is closed at the moment, and that will have some knock-on effects. The thing that gives me hope that the activity will still continue, because we've obviously been through a few cycles in our history, is the mountain of cash that's being raised by the growth funds and the private. Literally every day you're seeing a new announcement of a $10 billion fund, a record fund that's hit the news, many of the funds that we know. So there's still a lot of capital to be deployed. The question that I guess we're wrestling with is, what's the right valuations now?
But you think there'll be a feed through, though, that private market will start to match what's happening in the listed markets, or not?
It will definitely go through. It's just a question of, and normally I guess you see it's kind of 6 to 8 months, and then the private market catches up with the public markets, which will always adjust first. I guess the difference here is the amount of quantitative easing that went in and the success of the tech sector. I mean, it's been absolutely phenomenal. So that may mean the catch-up is slightly prolonged.
Mm-hmm. Per, you're investing across lots of different asset classes, as Manish said. What do you think about what's happening in the markets right now? Are you beginning to think there's some kind of bottom coming, or do you think things are going to get a little bit worse?
Well, I think the first thing that's important to establish is that the bull market run ended in November. It was a very long 13-year run coming out of the financial crisis, which created, I think, a very lax, very liquid environment where both really great companies, but maybe also companies that still have a lot to prove, all were highly valued, all seemed successful. And we're in a, I would say, a time of reckoning where I think investors and the stock market at large will sift through these companies at a much more detailed basis to find which are the real category leaders, which are the winners in the long run, and continue to back those companies. And I think for the others that have maybe lived on hyped PowerPoints, it's going to be a struggle. Then to answer your question, have we reached the bottom? Well, kind of the near-term macro clouds would indicate that we have not. You know, the markets have corrected a lot, particularly unprofitable tech have suffered the most, but also big tech have suffered to quite a decent degree. But we then have to break it into two parts, because we see in the B2C market, you know, software advertising, media to consumers, there's real demand weakness. So the inflation is impacting that, the war is impacting that, the rising energy prices impacting that. It reduces the wallet for the average consumer, which impacts for real. So there, I think we have a long way to go to find that bottom. The story in the B2B market, particularly in last week's, you know, reporting season, has actually been quite strong. So Microsoft, Salesforce, Adobe all reported on or better than expected, and pretty high expectations to go with that, showing that there's real robust demand in industry. And I would argue that one of the best things to do in industry in an inflationary environment is invest in software to reduce your cost of production so that you become less exposed. So it's a bit of an anti-inflation play, B2B software. So I think we're going to see the market operate in two halves probably for the next few months. But it may also very well be so that we will see a couple of false bottoms. So I think now is a very good time to be quite conservative as an investor, pull the trigger only with the greatest care, and in companies that are either profitable right now or where their core geography or business is profitable, and the losses you're making are calculated losses rather than making losses to prove that a technology works.
Yeah, it's interesting. And Hugh, have the stakeholders, has there been any realignment of the people that are maybe on the exit side for companies? We have talked about strategics, we talk about private equity. Obviously, the listed market's difficult right now.
Yeah.
Are you seeing any changes there? Is there any particular groups that are coming out at this point? Is it too early to say?
Yeah, well, I'll come on and answer that, but I want to pick up something you said, Per, because I think that what we've discovered since 2000 when we started the business, Ben, is that all tech is not created equal. I mean, when we started out, if you remember, technology, everybody in technology felt the same, even though the underlying business models, the underlying hardware, the software was entirely different. So I think what's really interesting about this latest correction is whether investors are going to be smart enough to differentiate between a computer games business, an enterprise software business, and a telecoms company. Because in 2000, they certainly weren't. In 2008, 9, I would say so.
Yeah.
And time will tell, because there's no doubt now that in some ways, technology is an entirely meaningless phrase. I mean, if you're not a technology business, you're not a business.
Yeah.
So really, it's incumbent now, I think, on investors to truly understand what these businesses do. Because the days of when all technology companies are 10 times revenues or 20 times revenues, I mean, that's gone. So I love this concept of driving towards more business to business, away from consumer, away from non-profitable towards profitable. I mean, it's a natural ebb and flow away from growth towards value. And I think that's what's going to be really interesting to see if we're all smart enough to make this sort of differentiation.
So then ignore the question I did ask you, because that's a much more interesting subject. So within those themes that are developing then, where do you think the interest will be? What are the core themes within the tech spectrum that you think people should be looking at?
Yeah, I think for me, the areas that were, I guess, brought to the fore by the pandemic, a lot of those will continue to hold true. I mean, these are themes that we've been writing about for 10 years. It's just that in some ways, we needed this sort of lockdown environment to accelerate a number of themes. So I'm very passionate, as you know, about online education, and that's been a huge theme. I think the B2B element of that is going to be fascinating. The B2C element probably less so. Clearly, organizations are having to figure out cybersecurity in a much more intense way. And of course, the warfare that you talked about, I mean, if that isn't accelerating people's spending on cybersecurity and defense in its broadest sense, I mean, I don't know what else will be. And then privacy.
Yeah.
You have a strong view on privacy.
I mean, absolutely. I mean, I think the world is also maturing in its understanding of the internet and what you want out of the internet. So we see a lot of kind of micro themes in that, from, you know, kind of the very risky crypto NFT end of the market to cybersecurity to privacy, the sharing economy. But another area that I think is very important to talk about right now is that the lockdown periods that are still ongoing in parts of Asia has created an enormous supply chain glut. And actually for the semiconductor industry in all its part of that value chain, this is a real positive. I mean, we have seen reports out from ASML in Holland, from Kalen Tencor in US, TSMC, where, I mean, they are giving upward guidance on their revenue projections for 2023, 24, and 25, because all their production is fully sold out. So yes, you know, we see, for instance, media tends to follow a lot the digital media side of tech, right? Companies like, say, Netflix and Spotify and so forth. And that's a bloodbath, because that's where it's very easy to stop using the service. It's not essential. But if semiconductors are not being produced, cars will not run, trains will not run, planes will not fly, washing machines will not wash. So again, coming back to how broad our market is, and I think what's upon us, and I think the luck we have with the size and breadth of organization we have is we have people in the firm who really understand various of these areas in absolutely the greatest detail. So that instead of being a tech investor or tech group, we can focus on the areas where there is continued strong demand. And that gives us a way to operate both in bull market and in more bearish environments.
Yeah, so there's parts of tech that are now indispensable, whereas the nice to haves maybe are going to suffer a little bit going forward.
And it's also the rate of change. We've been through such a dramatic period, and if you think about, we were doing a lot of deals on the investment side and the advisory side in kind of HR techs and managing this workforce, making them more productive, kind of checking on their well-being, and then the organization of these teams. That's all been blown up, right, by remote working, COVID, having to have a much more distributed workforce, and the technology is the only way that you're going to keep up with that into this new era. And then I think we love, I mean, one of the best things about our job is we see a lot of data, and then we also see a lot of trends, and then we'll sit down in teams and we'll start tearing it apart, and then you start really seeing, actually, from our user experience, these are the summer themes that are going to become really interesting. And I guess we were just sat down 2 days ago and we started comparing data on fitness trackers, Whoop, etc. But then we'd been to a few events about longevity, wellness, and there's a whole new dimension that's coming into this era now. So at the moment it tracks activity, but really what you want it to do is be giving you advice on how to really optimize what foods you're taking are going to really take you to that next level. And all of these, while the consumer spend might be down now, this could be a really interesting opportunity to start exploring the data you can build in and then devising some of these new apps. So I think a lot of people come to us and say, how should we react? How do we set up for this? And I think my advice is always, you never waste a good crisis. There's always opportunity. There's always deals to be done. And what we've seen in the valuations come down in the public markets, the buyout funds will take those companies private. There's a screaming opportunity. Some of the valuations have come down so much, and the buyout funds are looking at that. They've been waiting for this because they can finally acquire a fantastic software company that's growing 50% with great retention, low churn, all the dynamics they've been looking for, and very clear visibility on their history. They're now able to acquire that for the first time in many, many years.
I mean, we were just talking at lunch about Elon Musk's takeover of Twitter and taking that private. There's maybe another player in the buyout market, which is wealthy individuals or wealthy groups that may want to take companies private. What do you think about that, being that M&A is a big part of our business?
I mean, it's absolutely amazing. I mean, when you look at how he's financed that deal, and I guess we're seeing this on a smaller scale with many of the entrepreneurs that have invested in our funds and have had these exits, the firepower that they now have. I mean, Musk is effectively behaving like a buyout fund through his personal wealth and using his Tesla shares as security, but then getting huge amounts of debt because of his reputation and his trust. And we're seeing that across the unit. I mean, the amount of wealth that's been created by these tech entrepreneurs is unbelievable. And they're able now to start mobilizing that in a much more aggressive and larger way. So Musk is one. There will be many others that will partner with buyout funds, that will use their equity as collateral to start buying into the new companies. And there will be certain sectors that will see mass consolidation. So the smart are already starting to line up opportunities, start thinking about how they make themselves liquid when the valuations become even more attractive.
Yeah, well, rich people have been buying media companies for hundreds of years, so it's just another part of that evolution.
But also, I think, I mean, just to add to this, because I think this is really a trend that will grow. I mean, we have many super founders today that are very, very wealthy and can take a really long view. And you know, Wall Street is pretty short term. So we saw, you know, Niklas Stenström bought back Skype when he thought the price was right. Michael Dell bought back Dell. You know, this is not the first time we see this. And why can these founders that, you know, we work with make these brave moves or seemingly brave moves? Well, it's because they look at the product itself, not exactly how popular it is in the market in the moment. And I think it's really important when you invest in this space with us or elsewhere, is you have to take this 10-year view. I mean, fundamentally, what we are trying to do is to find the best software product in every category, whether it's in, you know, finding the next, you know, RDNA vaccine or helping people with HR or entertaining with a computer game. If we at core know the company is developing the best products, it will survive good and bad times. So you have to come back to the fundamentals.
Yeah, yeah.
And we see that like in our public fund, right? We see our competitors, I mean, are suffering greatly. I mean, performance for most tech funds year to date is anywhere between -35 and -55%. And we're up -14. So it's by far the best in the world. But in the good times, we were doing as good or better on the upside as well, because we're looking at what the businesses do, not what their quarterly report is showing.
Mm-hmm. Yeah. And so that's a good point. So our tech fund is down only 14% this year, which is fantastic compared to many. And our private funds have actually, after our first quarter results, we can tell everyone that we've almost had no move in our books on those as well. So they've held up really well as well, whereas Tiger Global and some of the others have seen extreme losses across those portfolios. So
yeah, but within that, though, what we've seen is that some of our very largest late-stage holdings, we've been conservative, and we've already done markdowns in the Q1 report in anticipation that the clearing prices will settle at a lower level. But what has held the boat up is that kind of the mid-venture stage or mid to late venture companies have performed terrifically well, because we're very long B2B, quite traditional products, and we have a good portion of all of our portfolios that are solid, profitable companies that reported great Q1s. So then we get write-ups in those, and we get a net zero result, more or less.
I mean, there's an amazing opportunity at the moment, because I think we see that there's a lot of people that it's probably non-traditional capital that's come into these late-stage companies. And then we'll sit across all of our categories. We love tracking the best companies in each subsector and then trying to think about the right time to enter. And we've had to sit on the fences a little bit because the valuations were just too stretched. But now there's a huge proportion of money, some of the crossover funds, some people that it's not their core business that need to liquidate their positions. And we've historically had some great returns at buying at that sort of stage, where they're the clear category leaders in a subsector we really like, we really understand, we're able to benchmark their data. And this is gonna be a really interesting time to start buying some of those stakes.
yeah, and to that point, that's why we've brought forward the close of Fund 6 from the second half of this year to June, because simply there are opportunities out there, and you know, sometimes you have to wait a long time for that.
Yeah, I think Ben, that the media love to make investors fearful. I mean, it sells newspapers. It's a good thing to click on. And I think we're in the innovation game. I mean, we're in the entrepreneurs game, in the innovation game, and that takes a long time. So as long as you have GDP growth plus or minus 2 or 3%, I mean, the businesses that we're backing over 5 to 10 years should be successful. I mean, this isn't a macro play. This isn't economics, a GDP play. This is a play about finding these superstar software founders and giving them a capital and the support to allow them 5 or 10 years to build a fantastic business. So that's a valuable business. It's a high impact business. And for us, it's got to be a global business. And so I don't think this is a time to be fearful. I mean, it's a time to recognize that we're at the end of something that's lasted a long time, 13 years or so. It's going to create great opportunities, but we still need to be patient. I mean, we've taken 20 years to build GP Bullhound to where it is today. And to be honest, that feels like just the beginning. I mean, it's like in Europe, it's building the platform for the next generation of successful entrepreneurs. I mean, 20 years ago, we didn't really know what we were doing in contrast to the US. I mean, we were a cottage industry. I mean, you moved to Stockholm, Per, I moved to Manchester, you stayed in London, and all of those hubs didn't really communicate with each other. And 20 years on, that's different now. I mean, we have 200 unicorns in Europe, worth close to $1 trillion. I mean, that's huge success. Now, sure, maybe $1 trillion is mispriced. Perhaps it's 25% less. I mean, time will tell. But we should be proud of the journey that we've been on, and we should not be fearful of the next 10 or 20 years, just because we've got a correction, which everyone, to be honest, has been talking about for 5 years, not for 6 months.
Yeah. Actually, that leads nicely on to the kind of next subject around talking about the next 10 years. And I know you guys have been working very hard for thinking about a proper kind of vision for that 10 years. Tell us a bit about how you think about that from a GP Bullhound point of view. How do you see us approaching the next 10 years, and what's the ambition?
Yeah, so why don't I start that off? I mean, for us, it's in some ways more of the same. We were lucky enough to sketch on a piece of paper 20 years ago the strategic framework for what we hoped the group would become, and that's what we call the entrepreneur's clock. So this is all about putting the entrepreneur right in the center of everything that we do, and then spending as much time as we can to build financial products and services around those founders. And for those of you that know us very well, of course, we're doing research, we're working on the corporate finance side, and of course we're investing increasingly actively across different financial products. But coming back to your question, Ben, I think for us it's about growing across 2 matrices. The first is geography, and then the second, of course, is products. I don't know, Per, if you want to comment on that.
No, I mean, it's absolutely right. I mean, what's so beautiful to see with our industry, if it's still an industry, is that there are great innovators, risk takers, entrepreneurs, founders, guys and girls in every country on the planet. And I mean, for us, and I think for anybody that is involved in software and internet, the world just naturally feels very flat. And we think it is all equally relevant. So every time we see an area or a region get large enough, we want to be there with people on the ground. At the end, you can be a very global business, but this is a human-to-human business. So we also need to be there locally. So when, the entrepreneurs are facing headwind, we can be there and support them. This is not just about supporting in form of making great investments or great M&A, but it's also just being there and being able to have a chat or give somebody support. I mean, to build these companies are not a straight journey. It looks like that when you look at maybe the valuation or the stock price, but inside the business on a day-to-day basis, and what we see from boards is that, you're always facing great challenges that you have to solve, and you have to have, good partners around you to support that solving. You feel quite alone. And I think what we can bring, that 200 GP Bullhounders can bring to that, is making that journey less lonely, less scary, and maybe a little bit less friction also, because we have an ability to open so many doors for these founders at every stage, whether it's, you know, doors to customers, doors to great CXOs, doors to other forms of capital, stock market, etc. Just making that slightly tighter, slightly nicer.
One of the really nice things in our job is we get to work with these amazing entrepreneurs, these amazing visionaries, and you learn so much from these companies, these individuals. And I think we've now worked with 27 companies that have hit that $1 billion mark, and then 7 have gone on to hit that $10 billion mark. And we've always been kind of trying to, as a firm and a team, say, keep raising the ambition levels. We don't need to sell at 100 million initially. Now we can build to 1 billion, now 10 billion. Now really what we're thinking, and we like setting these big missions, because this is what we've learned from the unicorns that we've worked with, is to say we've got to set this very aggressive and large mission. And then we have this very talented team that pretty much always figures out how to get there. And I think you can over complicate strategy sometimes, but it's choosing those big missions that really mean something to the organization as a whole. And I think we've selected those in good order. So one of the fixes we wanted to bring was there was real lack of venture and growth capital in Europe. So we set up teams to bring the money over from the US and started funding a lot of these companies. Then it was raising the ambition level so they could raise really large rounds. Now we've kind of set our sights. If I look at Europe and what's happening in the public markets, we're just not building companies of scale. So it really made me sad when people were telling me about the largest companies on some of these public markets. In London, it's Sage at 7 billion. And the only exchange that's really built some really large companies, funnily enough, Amsterdam. With a lot of our portfolio companies that have gone public, they're just not finding the European public markets working. So we've got to address that. If we're going to build these $100 billion companies now, we need that liquidity, we need that flow. So we then launched a number of products that's starting to take us in there, tackle that. It's going to be a long-term mission, a long-term game, but it's something that will then allow us to build those $10 billion companies into $100 billion companies.
Interesting. And I think also it sounds like there are other pieces of the puzzle that you guys are working on, especially around data as well within the organization. We have a new initiative there.
I mean, this is absolutely crucial. I mean, at the end of the day, we're also a technology company. It's true that the interface is human to human, but behind our decision making, behind our choices of investment is reams and reams of data. And that means our industry, just like the hedge fund industry, I would say before the venture and growth industry, is really turning into a software industry in its own right. So size starts to matter in a big way. I mean, we notice the more people we have on the ground collecting data that goes into our data plane, the value of the data plane doesn't grow linearly, it grows exponentially with that. I mean, we see every startup and scale up in the European and UK markets today. We see probably more than 60% in the US market. And that completeness gives a much better ability to operate. It allows us, for instance, to be truly thematic. What I mean by that is at any given time, we are really only pursuing 4 or 5 different themes within the software internet space. And we can allow ourselves to do that because we operate truly globally and we have a full map. We can see every company in the space and we have access to them. And that doesn't mean we're going to get it right every time, but it gives us the chance of choosing within it all. And that is also why I think, not just like the technology industry has turned from cottage to global, I think the investment and advisory industry is also turning from cottage to scale and global. And we are definitely pushing down that path with real ambition.
It's really nice when we're launching these new divisions or we're launching new products or new offices, and that we see every time we get that right, it really adds to the intellectual capital of the firm. And that drives this nice cycle of better returns, better clients, etc. And that's something that's really starting to accelerate now. And then when we look at some of the opportunities further afield, I guess as founders now, we want to have the benefits of that scale. So we've got the data edge, the data advantage. But then one of the really important things is to have the soul of a startup. And this is what we've learned from some of the best entrepreneurs. I'd say Hugh has been driving a lot of that on our side and keeping it collegiate, keeping it very entrepreneurial. And I think that's going to be one of our key management challenges over the next 10 years as well.
Yeah, I mean, maybe just picking up on that, because I think it is, it's part data, absolutely, as you say, and the three of us have been working really hard on this intelligence layer, which I think is the combination of data and people, and then the thematic research. And those three together allow you to be great stock pickers. But just to pick up on the people piece for a second, I mean, if the entrepreneur is in the heart of our business and the heart of great investing and great stock picking, then surely we need to make sure we've got the right people in the firm. And for us, they need to have two critical characteristics, Ben. I mean, the first is that they have to have a real passion for technology. That doesn't mean they need to be a programmer in C++. I mean, I certainly can't do that. But they need to believe passionately in the power of technology to bring about positive change in the world. And we really, really believe that. And everybody that joins this firm believes that. That's not an overnight success. It takes time. And there are a whole bunch of bumps and pitfalls along the way. But you need to believe, you need to be passionate about that. And the second thing, just picking up, Manish, on what you were saying about the soul, is you need to have an empathy for what it's like to be an entrepreneur. Because, you know, as you were saying, Pei, it's desperately lonely up there. I mean, you start these businesses and everybody tells you you're going to fail. Your partners at home tell you you're going to fail. Your family, everybody you try to hire doesn't think it's going to be a success. But you need to have a supporter alongside you. So you need to have an empathy for what it's like to be an entrepreneur. And so we try to hunt out these characters that somewhere in their past at university or their parents or their uncle had a business. So they really understand that. Arrogance has no place in great stock picking, in my opinion.
Yeah, and I mean, we have many concrete examples of that. And we see a lot of people in our industry want to use kind of the phrase do good, but I think the phrase should be do right. And, you know, when we invested in DuckDuckGo, which has become a great success, we did it because we're passionate at GP Bullhound that protecting the consumer's data, not having it resold and used in the wrong way is important for the whole of internet. And then that leads to a good investment rather than the other way around. When we invested in Monocle, that helps scientists across competing medical firms to create new solutions, like our DNA comes out of that. We do it because we think it's the right thing. All of us, I think all 200 feel that. And then it turns out that when you start with that thinking, you often also get a good economic result. But I think you have to marry the two. And in fact, I think some of the talent we have in the firm have so strong opinions around this that we really could probably not act in any other way.
Yeah. No, I think that's right. And I mean, the diverse set, I mean, I was looking recently at talking to the people team. I think we have 35 nationalities with 32 languages. So that's a pretty diverse set of cultures and views. And we're not a cookie cutter firm. I mean, we don't want everybody to be a robot. We want people to share the same values, but to have very different personalities. And that way, again, I think by driving diversity into the organization, it allows for much more independent and creative thought.
Mm-hmm. Are there any more practical ways you're trying to drive diversity and a kind of a sustainability to the business going forward over the next 5-10 years?
I think there's probably two initiatives that we feel very proud of. The first is an initiative which we started last year called Future Stars. This is a two-week work experience program for university students to give them a flavor for what it's like to work in an investment bank and to work at GP Bullhound. And that's coming up, actually. We have 100 across all of our 12 offices coming into the firm.
Yeah.
And I think going by the success of last year, where I think we now have 3 or 4 full-time members of staff.
Callum here in the room, actually,
Right.
with us.
Yeah.
Of the success.
No, I mean, it's great. And
Yeah.
so that's financial services and technology are not a perfect melting pot for diversity, right?
Yeah.
So we need to work hard to drive diversity into the organization. So that's one initiative. And the second one, which has been really organized by the CSR committee, is our latest EcoVadis rating, where we got the big gold stamp, which suggests that we're definitely on the right path when it comes to ESG.
Yeah, I think for the fund as well, we'll be reaching level 8 from the EU standards for the next fund as well, which is as high as you can go without being an impact fund as such. But interestingly, there are impact funds looking at us because of the story around entrepreneurs that you mentioned, the way we kind of birth a new generation of companies using the money, which, as you know, most of the money of our funds comes from entrepreneurs and tech-related people, and putting their experience and their resource back into that next generation of companies is actually a really nice story as well.
Yeah, but I think it's important to do this for real, right? I mean, there's also a lot of greenwashing in our industry,
Yeah.
to be honest. So I don't think we need to call GP Bullhound the impact fund. I mean, we have to invest to make the world a better place. I mean, we just made an investment in a company where the founder came out of Africa. I mean, he told me just a few weeks ago that when he grew up, he had not seen cutlery. He comes from that type of background. We didn't invest in the company because of that. We invested in it because he was an incredibly charismatic, powerful founder with a fantastic software product. So it comes through the natural focus of trying to think about what are the products that do the right thing for the right category, because there is diversity in that. I mean, women, men, old, young, and any nation are trying to solve these problems. And that's what gives the founders their passion.
Yeah.
And I think this is one of the exciting things when we think about 10 years ahead, is that the amount of wealth that's being created within these entrepreneur groups. I think one of the stats we love tracking is that you take the cohort of the most successful European tech companies and combine them. And in 20 years, kind of that combined value reached 400 billion. Last year alone, we created pretty much the same, 400 billion. So 20 years of value created in 1 year by these best companies across Europe. And now they're all, in a similar way to Musk, they're getting so much cash that they want to deploy in good causes. And it's also thinking about how we can extend our product range, our set, to also cater for that and start driving it. That was the premise that we started the firm in the first place. We were so inspired by Silicon Valley and that pay forward, that ecosystem where everyone was like, it's a meritocracy, people sharing content. It was so alien to us. And now we're seeing that in a quite fundamental way in Europe. And then there's going to be this explosion now because of the success the sector's had. And that can do a lot of good. We just got to make sure we all stay grounded, humble. The Valley's had its ups and downs. And I think Europe almost can also look at this now and say, we're going to learn from that and make sure we manage this in the right way.
But just to pick up on that, because you mentioned a very important word here, cash. I mean, probably the biggest worry to most investors on this call is inflation.
Yeah.
Because it's no longer a ghost. It's standing here in the room. And at least my forecast is we're going to see inflation for a long time, which means that interest rates are going to go up inevitably. I would say back to normal, which we haven't had for, a decade and a half. We operate in an unlevered industry. We are probably the only industry in the world where this is good news, not bad news. I mean, the big tech companies are the largest holders of cash outside of, sovereign funds on the planet. Even mid-sized venture and growth technology companies, the best of them have all raised very large amounts of capital in anticipation of the market turn. Because just as Hugh said, I think for us in the industry, we have been waiting for this turn to come for quite a long time. So people, the best founders, have taken precaution around that. Our colleagues at, Silver Lake, Sequoia, Carlyle, they have all raised very large new funds, unlevered funds. These are not levered funds. So it's cash going into companies with cash with no leverage. So if anything, the return on this equity goes up when you also start getting interest on the cash you're holding.
Yeah.
And you're not exposed to inflation nearly in the same way.
Yeah, which also makes the industry non-systemic in terms of spreading risk to other industries because we're not borrowing from elsewhere.
I mean, I think the other, I really like that comment around cash, and I would say the other word I've been thinking a lot about recently is patience. I mean, it takes a long time to build a great company. I know, again, the media love to talk about these overnight successes, but they're never an overnight success. I mean, they're 10, 15, 20 years in the making. And so, if you come back to the strategic framework of the entrepreneur's clock, this is an incredibly patient strategy. It's about meeting an entrepreneur with a great product that perhaps doesn't have a customer yet, writing a piece of research about them, inviting them to an event. 5 years later, as they've broken through, perhaps investing, and then maybe 10 or 15 years later, when the business is sold to Google or Facebook or Electronic Arts, at that point, go back to the founder once we've sold that business and say, listen, why don't you invest in the fund? And then who knows, hopefully they'll go on to start the next company and then the next company after that. So we have more Nicholas Enstroms and we have more Elon Musks, coming out of Europe. But it takes a lot of time. And I think it's very easy in a market where we've seen such volatility over such short periods of time to forget about the underlying ambitions of these businesses and just take a deep breath and hold on to your bets in many cases. And I think, as Per was saying before, we're really proud of the portfolio that we built, and they seem to be holding up really well.
It's interesting on the M&A side, because we touched on that on a couple of fronts, and the amount of cash that the large tech companies are sitting on is astronomical. And then and this is where it's important that you have that kind of whole view of the data, because if you look at the press and you speak to people in the market, they're saying M&A Q1 down massively, like 30-40%. And you kind of see that, and that's correct by the kind of value of the transactions. But then you look at the number of transactions that were closed, and it's the record there's ever been. So smaller deals, but still a huge amount of deals are closing. And of course, when valuations are coming down, the total volume is going to be less. But when you see that trend and you hear from the mega caps and some of the corporates that are gearing up for this, they're going to step up activity, because we talk about these sector, and we haven't even mentioned the Metaverse, right? Everyone is talking about the Metaverse. And in reality, the Metaverse is it's an existence, it's a point in time that's going to come. But to get to that infrastructure where you really have this seamless experience without a lot of headsets and hardware, and it should be seamless through your mobile phone, the infrastructure's got to shift almost 1,000x to be able to cope with that sort of experience. So all of the large corporates are shaping up for this. They're going to have to deploy huge sums to start building that infrastructure and to start leading us on this journey. And that's going to happen over the next 5-6 years.
Interesting. Per, Metaverse? I know you love this subject.
No, I don't think humanity, to a particularly great degree, want to live in a fully artificial world. So I'm much more on the side of an augmented reality future where we can use technology to improve our existing life. So I think, the research that we're doing around longevity and health and preventive healthcare is a kind of form of verse that I find more interesting than the Metaverse. I also think that the use of technology in our day-to-day lives is very impactful. I'm a very passionate sailor, so we see the top of our game is the America's Cup sailors, and they're in a fully augmented reality when they drive those boats today. That they couldn't do it without technology overlay because they're so advanced. I find that very fascinating. I think we will see that type of metaverse enter into the medical field. In the future, a surgeon will not do surgery without both robotic help to not shake, but also to see more about what's going on. We will see pilots do that in airplanes. We will see drivers do that in cars and so on and so forth. And this is cool technology, but it kind of creeps up on us because it's like somebody says, when technology is really good, it feels like magic. So you don't think about it as technology. I think a good example of that to me is Google Maps. I use it all the time, right? I don't even remember the name of roads anymore. I just follow Google Maps. And that to me is the kind of augmented reality that I think is going to grow a lot larger. And I think is a bigger market than kind of this more entertainment metaverse. But then there are other areas that are incredibly important as well. For instance, we have not at all talked about quantum computing. But I think we are within 10 years from a breakthrough in our industry of a very significant scale, which then will start to allow us to simulate maybe even the whole of reality. And then we can start solving very challenging problems, both around the environment and the survival of this particular planet, but also, for instance, the very advanced system of our brain and our bodies. And I think that will happen, within our lifetime.
And so looking forward to Fund 6 then, you mentioned quantum computing. I'm guessing it may be a little bit early for Fund 6, but what do you expect from Fund 6?
Yeah, well, it's very important when one considers investing in our fund is we do not invest in what I define as future technology. So we are analyzing the metaverse, AR, quantum computing, all sorts of things, right? But we only invest once an industry is actually a real revenue generating industry with either millions of consumers that are demanding it or thousands of enterprises or government entities that need it. So we are an investor in what I would say mature software and internet companies. I mean, if you think about the Gartner hype curve, at the kind of first end of the curve, where many of our colleagues operate, which is super exciting, and you can make fantastic returns. Yeah. Sure. We follow that with great interest. We then see kind of the peak of that and how it comes down, and often comes down quite a lot. And at that time, we find that it really tests the mettle of the entrepreneurs. And the top 10, 20% survive and come out a lot stronger. And at that point of proven strength, with a proven strong underlying market, we want to enter. That means that we are quite late stage bias. I mean, these companies are typically rather large, but it's not because we focus on a stage, it's because we focus on that aspect of resilience. I mean, as you know, I mean, within our kind of growth equity pot, which is 80% of each fund, we have, and knock on wood, we have 0 death rate. I mean, we may create a negative return because maybe we overpaid and it's worth less 2 years later. But we are working with companies who have real customers using the technology on a daily basis for important real matters.
Yeah, Callum actually just mentioned, I think it's 67% of our companies are either profitable or can become profitable when they want to. So it shows we're in the right space for this kind of market.
Yeah, and of course, I mean, if companies were super profitable, they wouldn't need our capital. So what we try to find is this crossover point where a team of founders and the market they've served have proven, let's say, in a region or within a subset of an area that this really works. And then they're looking for capital to expand either geographically beyond where they're standing profitably or within the product set. So maybe it's a niche product, for instance, within HR software we mentioned earlier, measuring the satisfaction or happiness of employees. And maybe they feel there are multiple opportunities around that, like improving payroll, improving talent management. And these kind of stories, when we have strong founder teams that have proven something that works and works in the real world, and then giving them capital to take some risk to build upon that, we find very appealing.
Interesting, okay. We do have some questions here. We've touched on a few of them, but what areas of tech are we all undervaluing the potential impact of right now? Is there anything that you feel inside you that the market isn't valuing properly?
Well, I think the one such area is I think the merge that we are going to see between the medical world and drug discovery and the software industry, because actually they are very close together today. And I keep on mentioning RDNA, but RDNA from my perspective is actually software programmed molecules, right? So what's been two very separate worlds, one done in lab and the other one in code, is now coming very close. And this is, a multi-trillion-dollar opportunity. I also think, and maybe specifically to Europe and US, that is very, very fascinating to recognize that we will rebuild in Europe and in US our own semiconductor industry to reduce the reliance of China and Taiwan for these absolutely core essential products. That's also, to me, $1 trillion opportunity that is not talked about much. But in our space, you have to always search hard to be able to say, yes, this is underpriced. I mean,
Yes, that's true. Yeah.
fairly priced. I think we can work with that.
There are going to be some interesting, and this is what we're getting our heads around now. There are some quite interesting opportunities where the whole sector is so decimated because people are very bearish on e-commerce for some of the reasons we've spoken about on the consumer side. And logistics, the supply chain, I mean, it's tough. Everything is counting against them after such a boom during COVID. So then pretty much every e-commerce stock and every marketplace stock has been crushed, and they've gone to similar multiples. But we also know, having worked with a lot of the best marketplace companies, the dynamics are totally different. They don't hold any of the stocks. They're not really beholding to the same supply chain issues, and it's not the scalability of those businesses is much greater than a traditional e-commerce store. Is it the right time to enter? Probably not, but is it worth tracking them and seeing where those valuations? Absolutely. And then I'd say there is a software sell-off across the board. And again, it's kind of everyone in software is being sold. Everyone in cybersecurity is being sold down. There are one or two now that are starting to emerge where we're seeing the growth rates are still at a very high rate. The unit economics are good, but they've been hit by the total sell-off. Those are going to be the interesting opportunities that we then start entering.
Yeah, I would say that, certainly at the investment committee, we've been seeing a few travel tech businesses for the first time in 3 years, probably. And now valuations there are probably creeping up pretty fast, given how much we're starting to travel and go on holiday and all of these things again. But that's been an industry that's been decimated, and a lot of businesses have gone out of business. So your point about Manish, not wasting a good crisis. I mean, travel tech could be an area where maybe for Fund 6, it's an area that we might look into in a lot more detail than perhaps we have done for Fund 4 and 5.
Yeah. I mean, I don't think you can ever have a technology webinar without mentioning blockchain. So let's
Done quite well so
let's
far.
mention blockchain.
Nearly got to the end.
I mean, I think it's very important to say that. I mean, I think we are fascinated by distributed ledger technology. I think we're seeing a whole new kind of Web3 infrastructure being built and proliferated. I think still the end consumer product, we want to see more maturity in that. And of course, we've seen very extremely high valuations here in this space and extreme volatility. But I think, so even though we have not been very active on the investment side, it doesn't mean we don't think this is very important technology being built, taking us back to a more neutral internet that is neither controlled by big tech nor controlled by government. And so you can see derivative investments we have done, such as DuckDuckGo or Patreon, are really derivative consequences of a movement that we see in the entrepreneurial community of taking us back more to the kind of Berners-Lee idea of internet as an open platform for all humanity to share and participate in at will.
Back to the dream of what it was all set up for in the first place. I just wanted to, before the end, ask you guys, I mean, you've been doing this for 20 years now. I know the vision is for many, many years to come, decades. You talk centuries recently. But you as individuals, how do you chill out from all this? How do you relax? You mentioned sailing, Per. I know you're a competitive sailor, very successful one. There's something about entrepreneurs and sailing. It comes up all the time. Why is that your subject? And maybe the other guys can tell us as well what gets them relaxed.
Well, I think what's good in the sailing environment is you're seeing the horizon instead of a computer screen. And it's quite complex. So it gives at least me a complete break from the day-to-day work, because I don't have it in my brain to be able to do both at the same time. So I find it's a bit like a, Control-Alt-Delete of your computer, or a turn on and off of your phone. You feel clean afterwards.
And Manish, I know you're appearing on the senior tennis tour this summer, aren't you? So tell us a little about your sports.
Well, the tennis tour, I think is cool. So I think I love any sport. So I think it's a similar thing when you can get into that flow and you just can't concentrate on anything else. So tennis definitely does that for me. Football does it for me. Kickboxing. And then when I go to Barry's boot camp with you and you're kind of whooping and rip your top off, that definitely makes me forget about work.
Moving on quickly to Hugh.
I think that sounds very sensible. But, I mean, I think we all had a kind of epiphany moments during lockdown. You know, some enjoyed it more than others. I would say I definitely didn't enjoy that period, and that made me reflect quite a lot about what I really did enjoy doing, and it comes back to spending time with entrepreneurs, not on Zoom, not on the phone, but face to face, to feel that passion and feel that energy. And so when I wasn't able to do that, I had to replace that with something else. And for me, that was running. And not just on the roads, I hate running on the roads, but on the trails. I live up near the Peak District. So taking the dog and a pair of trainers, opening the door and running for me was a replacement for mindfulness. I'm not maybe I'm a mindful person, but I'm not into mindfulness and meditation. So for me, that gave me a great release and allowed me to really focus in on how I could somehow construct environments and situations to spend time with entrepreneurs. So I created this kind of entrepreneurs dog walking club. So that we could actually spend time legally together, albeit socially distanced.
Well, I agree with you totally. I think the reason I'm in the job is to spend time with entrepreneurs. We're very fortunate that we have nearly 300 of them as investors in the fund. And, we hope you'll be joining us again in Fund 6. I think we know that we've heard that the best vintages are often created after a crisis. So I think the timing could be really interesting. We're going to have a first close on Fund 6 on June the 16th. And, the last fund was heavily oversubscribed, so do bear that in mind. But we do want you on this journey with us again. And I think you can see that we see opportunity in the market right now. Not necessarily a time to be cautious, but that's why we're moving forward. So thanks to the team. Thank you all for this special webinar. Thank you all for joining us. And I look forward to seeing you all again soon. Goodbye.